Alright guys, in this video, we're going to compare Lemonade Insurance with Root Insurance and see which one I would invest in. So first up here is Root Insurance, and it was essentially built around one simple idea. Insurance rates should be based on how you drive, not demographics. They use mobile technology and data science to offer drivers fair, personalized car insurance rates. All of the insurance is done mobily, as you can see in the graphic here, from account creation to your test drive, where they will personalize and customize a policy for you, based off of how much you brake, your speeding, your average mileage, to creating that tailored plan and pricing it for you near instantly, and even the claims are all handled through the mobile app. So here are some highlights about Root Insurance. The proprietary tech platform with that creates these customized plans based on how fast you drive, braking, mileage, etc. And the data they collect from people driving, has drive some of the best loss ratios in the industry. Their platform is, gives a very differentiated experience in the sense that it's only 3 clicks to purchase insurance, which is very different from the traditional market. And they have plans to go national and keep growing. So why would someone invest in Root? Well, basically, you can see here the massive auto insurance market opportunity, nearly 346 billion and another 33 billion if you start to package, home insurance, renters, pet, etc. Next on the line is that the amount of data, we're creating a customized policy off of how fast the driver goes, how many miles they go, how often they brake. Just like AI, the more data it receives, the better decisions it can make. And lastly, you can see the trend coming through here with, the orange little shades here being the darker orange being embedded and the light orange being direct. And you can see that people slowly over time, these gray regions going down, they're moving away from brokers and independents and captive agents and branches and going straight to the company or online. Here's a graph showing the company's loss ratio over time. You can see in 2018 it was over 100%. They dealt with the scale up, they dealt with the COVID challenge, and now they're making it out on the other end with about a 60% loss ratio, which means, for every dollar they collect in premiums, they get to keep about 40 cents of that profit. So let's take a quick dive and hop into the income statement here. Very impressive top line revenue growth here. 2020 they were at 300 million and they just cracked 1.2 billion, so they quadrupled here in the span of about 5 years. And if you look at their net income, they recently just turned positive here in 24, and in the LTM, even more impressive. Hopping up from 2.5% margins to 6. And we all know how net income can be distorted. So I decided to take a look at the cash flow statement, and looking at the cash flow from operations, which, get rid of the depreciation, get rid of all the fake expenses. Actual cash came in the door after we put cash out the door, and they're positive, which is, what you like to see, a company starting to turn here, and 195 and 197 here million in free cash flow generated in 23 and 24. So I got Root Insurance here, Progressive Insurance, and Travelers Insurance, and all of their forward-looking valuation metrics. And the tell here is that Root's actually kind of looking pretty cheap here. They're trading only at 0.66 and zero point 0.8 times, EV to revenue or price to sales, when competitors are trading more in the 1.5 to 2 times range, indicating that the company probably is undervalued. Lemonade Insurance is a AI-driven insurance company that offers a variety of policies. Unlike Root, they offer renters, homeowners, car, pet, and term life insurance. The company provides these insurance policies just like Root, being all online, with the focus being on the new AI-powered technology for instant claim processing and online policy management. And just like Root Insurance, Lemonade has proven that they continue to lower their gross loss ratio. So, right, we can see that their gross loss ratio here in Q2 of 2023 was 91%, meaning, if they collected a dollar, they were paying out 91 cents in claim. And they've been able to drive that downwards to 70%, hitting their target range in Q2 2025 in just 2 years. So basically, the story with Lemonade here is how they're able to leverage AI to lower costs and increase revenue. Taking a look to the graph over here, you can see their in-force premiums have increased from $609 to $1,083 in 3 years, while their operating expenses have essentially stayed flat but really decreased from $87 to $80. They've been able to add 800,000 customers in the past 2 years with headcount decreasing by 4%. That's the power of leveraging AI. So Lemonade is essentially able to secure some pretty good customers way before their competitors. And what I mean by that is here, if you look, the average age of a Lemonade customer for insurance is 35 years old. And the average age of their competitors when they onboard a client is 45. So they're getting 10 years ahead and collecting that premium and that loyalty over time. And also a nice little addition is the breakout here of their what they provide insurance for: homeowners, pet, car, and life, with car being the bulk here. And Lemonade is the preferred brand among the next generation of insurance buyers. They're the number one brand for people 22 to 40. They're the most searched in terms of renters insurance and the most searched in terms of pet insurance. So if we take a quick look to the income statement here, the revenue growth has been very impressive. They've accelerated from 94 million to 600 million here in a 5-year period, over 6xing when Root did about 4x in the same time period. On the other hand, Root is profitable and just turned profitable in 24 and is profitable in the LTM, but unfortunately here our net income is negative. So checking up on free cash flow, in my opinion, the best measure of profitability, it's actually looking better than the net income. And what I mean by that is, net income you can see at 200 million, but the cash from operations, literally meaning just from their operations alone, what they brought in the door versus what came out the door, and they're only at minus 11 million. Making their way down from 163 million, definitely trending in the right direction here. And if you remember from the looking at Roots valuation metrics against Progressive and Travelers, they're trading in about the 1.5 to 2 times range. And if you look here, you can see Lemonade's trading much higher. They're trading at 4.5 times, maybe showing that the stock's overpriced. But in my opinion, the company, which we'll see in the next slide, has a lot better looking forward projections than Root. The present value of a company's future cash flows is how you determine the price of a company. So, looking at these historical metrics I just gave gives you a good indication for how the company's run, but doesn't give you much about where the company is going. So, I just wanted to kind of amplify this by showing you side by side here. We have on the left, we have Root and their projections, and on the right here we have Lemonade. And if you remember too, right, that the for Root Insurance, their revenue multiple was below industry. It was at about zero point 0.8 times. And I believe the reason for that is this slow anticipated revenue growth. They're slowing down to single digits where they've been double digits for a while, and multiples. People pay a lot of money for high growth companies. That's where high multiples come from. And if you look at Lemonade here, they're still going to be trucking out. In 2026, expectations from all the analysts here are 63%. I mean, they're going to be growing 6 times as fast as Root. That's why they're trading at a high multiple. And I'm not against high multiple companies. It means they have to execute in their price for perfection. But a lot of the time when a multiple's high, it's because, you buy good company costs a lot of money. Bad companies go for cheap, you know? So, and when I'm looking at Lemonade 2, right, the main consensus here is that Root's making money. You can see in 2024, right? Root has been making money. You can look at their EBITDA, 112 million, when in 2024 we're not. But let me tell you this, if you look at projected free cash flow for 2026, we got 132 million and we got 11 million in 2026. So Lemonade is on track to be positive. So basically, Lemonade uses AI throughout every aspect of the business, from onboarding to claims to customer service to risk pricing. It's digital native. They have multi products from pets, homeowners, renters, life, car, while, Root just has car. They have some of the best, Lemonade has some of the best customer satisfaction scores in insurance. And lastly, their management team, which I haven't really touched on here, is extremely impressive. The Root story seems to be get the best drivers with good pricing, churn off bad drivers through high pricing, and take the 10 to 20% of the best drivers of the market. The Lemonade story seems to be, get people with renters, pet, and home insurance, then convert them to their more profitable auto insurance line and keep the churn low through bundling these insurances all through one app. If I were Geico or Progressive, I would be taking these companies very seriously as competitive threats. I mean, both are great. Root makes money now, but I believe in the future, Lemonade's going to outpace them in terms of revenue and profitability. And their management team, I like a lot more. And they have more diverse product offerings. They utilize AI throughout the whole enterprise. My pick would be Lemonade. All right, so that's it. That's all I had for you guys. I personally like both companies. I think they're both great investments. I just am leaning a little more towards Lemonade. Let me know in the comments what you guys would pick.